Welcome to.
Testing,
I was.
testing. All right. So, hello everyone. It's Prominent Lending Group. I'm Ricardo Salazar. This is Robert Duffy. Um,
Hi.
this this is our first episode, and we just wanted to start a live broadcast to connect with several of you in regards to home loan mortgages, buying single family residence or condos or townhomes, multi units, um, and wanted to have an introduction on this first episode between Robert and I. We both work with, or I work under Rob. He's the broker for Prominent Lending Group. Rob, why don't you introduce yourself and give a little bit about your experience?
Hi, Robert Duffy, Prominent Lending Group. I've been in the business for a little over 25, about 25 years. Started off in a retail boiler room, basically. They shove you in a room and you just make out calls all day or take inbound calls. Then I moved to wholesale, worked in wholesale for about 6, 8 years, and then went out on my own and started this business with a friend of mine and been doing it for the last, I don't know, 14, 15 years.
Cool,
That's about it.
cool. So when you mention retail or wholesale, can you kind of break that down for people that might not
Sure.
know what that
So
means?
retail is the front end of the mortgage business, which is what I do now here too, but it's my own business, and you work with consumers. Whereas wholesale, you work with the brokers or direct lenders or the banks, and you buy their loans. So on the
Gotcha,
backside, we were buying or brokering loans through them,
gotcha,
or we
gotcha.
did everything from wholesale lending to actually setting people up with wholesale warehouse lines and allowing them to be their own banks and all of that kind of stuff.
Yeah, that's quite the experience, on both sides. So not just dealing with the clients, but also dealing with a different level of clients, like business to business versus business to customer. So yeah, but ultimately, kind of the same type of because we're all human beings, whether it's a business to customer or business to business.
Well, you might be a human being. I'm not.
Oh, that's right. You're actually. I forgot to mention that Robert's actually a AI representation of the broker. So
Yeah, I wish.
we like to. We're gonna have a little fun with these episodes instead of being super super serious about everything. Yes, we're going to talk to
It's
you about data, about information that's useful, practical, whether it's about mortgages, real estate, improving your credit, figuring out how to, qualify for a home loan to buy a house. What's debt ratios, what's payment to income ratios, taxes, insurances, homeowners associations, all these different expenses that come into play when you decide you want to become a homeowner, right? So, but during all that information, we're also going to have a little bit of humor in there to keep it a little lighter and more entertaining. So,
or lack of humor.
exactly.
Um, a little bit more. I mainly, and for the last, I don't know, 3 to 5 years, I've been primarily focusing on investment type properties. So investors who are looking to buy property or refinance property, get cash out, that kind of stuff. I work with a bunch of different investors who own multiple properties and they're always looking for different financing. So there's a little more experience besides just the normal first time home buyer or primary residence. A lot of the stuff I focus in nowadays is primarily investor properties. So
Gotcha.
we can also talk about that if it's something that somebody is interested in getting into. We can go into that. But I think what we'll probably do is start off with the basics and then move forward.
Yeah. So overall, how many years was it? Did you say 20 years
Too
or?
many. I'm almost at 25, I think, somewhere around 25, give or take a year.
Wow,
I don't
that's
know if
great.
I've hit the actual number yet.
Excellent. So yeah, you've seen a couple customers. You've helped a few.
Few. Wholesale is where you really get the advantage because you see so many loans, whereas a retail person, you
Right.
see just the clients you work with. With wholesale, you're looking at thousands of loans a month.
Right. So
You know,
that volume is
you're
just coming quickly, and you get
you're
to
and
dissect
you're
so
having
many
so
different.
many different scenarios put at you,
Right.
that you are forced to figure out if you can get them done or not. So that's where the
Right.
best part of the experience came in. I think was those, I don't know, 5 to 8 years in wholesale where, you know, you're just every day you're looking at a couple hundred different loans just to pre-qualify them or help a loan officer figure out how they're going to get it done. And I prided myself on being able to, even if I couldn't get it done through the company I worked with, I knew where to send it. So a lot of people would call me as a default, and then I would stuff them off and say, hey, call this guy, call that guy.
Right. Right. And you know that's
And, and that's how I met Ricardo, because he worked at one of the banks that I was an account executive at.
yeah. In
So
fact,
tell us a little bit about yourself, Ricardo.
well, yeah. I mean, I've
Get it off of me.
get it off of you. Well, you're giving you're sharing your knowledge, man. I mean, that's why we're working together is because it's a good duo. You know, we have a lot of experience between the both of us. Well, I've been in kind of the sales, you know, whether it's customer based or a lot, I would say more customer based, like 90% of it has been customer based instead of business to business. It's business to customer. So directly dealing to help the customers face to face. And you learn a lot. Am I perfect at everything today? No, I've learned a lot to minimize my imperfections or my errors, my mess ups. Um, but yeah, I've helped a ton of people over the years. Whether originally I started in automotive back in 1996 and got into finance in automotive, and in 2002 transitioned into mortgages. So now I have licensing in mortgages, and I still do automotive financing as well. But the mortgages is where we're paired up here with you at Prominent Lending Group. So yeah, I mean, helping out clients, I guess my approach has always been figuring out how to take a complex thing like whether it's mortgages or real estate and all that language, industry language that happens that might be a foreign language to the customer, trying to translate it into simple customer friendly terms. I really like doing that. Speaking a couple different languages helps also because I'm always trying to translate between Spanish, English, whatever it is. So it kind of helps to know a few languages. But breaking things down is for that in a way that's easy for customers to interpret and make a decision off of the information is what I like doing, and it's helped me out a lot. The other thing I like to do is, you know, I kind of like to geek out on lending guidelines. What does that mean? I go into the depths of it all because a lot of people don't like to worry about all the details, but I like to dig in there because I know that once I understand a lender's guidelines, whether it's a Fannie Mae product or a Freddie Mac product or a non Fannie Mae or a non Freddie Mac, which they call non QM loans. I just like knowing the parameters of what gets us to a funding moment, right? Because once you understand that, you can have confidence in proceeding forward with customers and really being able to complete the transaction for them or give them the feeling that you're confident that you know how to complete the transactions for them. Because I know a lot of customers get started with other agents that might not be as experienced. They might be newer in the business and they might feel like, hey, after talking with this particular loan agent, maybe that's not the right person to proceed with. So, you know, starting this podcast is really going to help showcase kind of our experience level and how we like to handle clients, and hopefully connect with a few more clients and maybe earn some more clients and get the opportunity to serve them. So,
And also hopefully educate our own personal clients when they have a topic that they're not understanding. We
right,
can shoot out a specific thing to them and say, here, this will explain it a lot better. And we don't have to waste it. They can learn about it on their own time instead of us explaining it to them on the phone in greater detail than the short amount that we explained to them on the phone. So we're hoping to have it topic based too, so that you can cover different topics.
Yeah, absolutely. And that's, this whole introduction is kind of the introduction of our channel and the introduction of our way forward in working in this technological rich environment, and
Right.
how we can duplicate what our experience level is, what our personality is, what our client handling method is, and
Right.
connect with more people, and help them feel good about moving forward and becoming an eventual homeowner, so that maybe
Right.
as their property value increases from the house that they personally live in for a few years, they can turn into another client, like you mentioned, where they're an investor now. Maybe they're tapping into some of their personal residence home equity, and they want to buy additional investment properties. So it's a great way to
Or
expand their portfolio.
they're having a hard time qualifying for a starter home, and maybe they look at a 2, 3, or 4 unit,
Right.
and they buy a 2, 3, or 4 unit while they're young. I mean, these are the things the things I know now are what I hope to give to people that I wish I would have known when I was 18 years old. Because since I've looked at so many people's um, credit over the years, and I see the people that have been very successful, and they started out young and they started buying houses in it. When you're younger, you have different expectations of where you'll live. While you're in college, you don't mind living in a dump.
Right.
Well, instead of renting one, why not move into one yourself? Maybe a 1, 2, or 3 unit, or a 2, 3, or 4 unit. Excuse me. Rent out one of the units or 2 of the units. Have them cover the majority of your mortgage payment, and then when you're done with school or after a couple of years, move out, do it again, rent out that room, and now you've got a place that's self-sufficient, and you're getting better pricing as a owner-occupied instead of a non-owner occupied. So you've locked that in. Um, I say the best example of people I look at are people that they got out of high school, they went into the military. And you don't have to go into the military to do this. This is just a good example. People have done it in different ways, but they go into the military after they get out of basic training and they get their first post. They buy a house close to the base. Maybe they're there a year or two, 3 years. And then when they transfer, they've already figured out that they can rent it out for more or the same of what the monthly costs are. So they get a local realtor to handle it for them, or a property management company who charges generally a fee of about 10% of the rent. And they move on to the next post. And since it's next to a post, it's really easy to find people that are moving there that need a house. So that realtor puts a different military person in, and they're paying your rent every month or your mortgage there every month. And you've moved to the new base, and then you buy another one at the new base. And generally what happens is over the 20 years that they spend in the military or less, they've bought uh, 3 to 5 homes by the time they get out, because they've had 3 to 5 moves during their time in the military within the United States. They're not buying them out of the country, but I guess you could look at that. And so now they've retired at 38, and then from the military, then they go into a civil service job with a state or a local, and they start to put in another 20 years there, and they buy their, now they're settling down, they buy their main house. And by the time they hit retirement, at 55 or 58, and they retire, they've got a military pension, they've got a city pension, and they've got 4 or 5 homes that are paying them anywhere from $10,000 to $20,000 a month in rents, and all of those properties are either paid off or really close to being paid off. Um, and they've got so much, and then they probably somehow along the way they've had part-time jobs while they're in the military where they hit all the marks for their Social Security, and they're also getting Social Security or a portion of it because they're probably getting backed down because of all the income they have coming in. And that's not even talking about their pensions. So, you know, I mean, that's if you can start out young and you're willing to go in an area that you know needs to improve, time is generally on your side because those areas that are a little tougher to live in now tend to turn around over time and get improved because people start to buy in there and fix it up, and the next thing you know, and nothing's guaranteed, but you know, even then, you rent it, so you live in it for a couple of years, you put up with it. I mean, I've lived in some places while I was younger that you know I look back on and I laugh now, you know, but um,
Right.
that's
I
what I
think
would.
we've all been
Uh,
in. I think we've all been in those types of situations. So
yeah.
yeah.
The one thing, you know, Ricardo kind of downplayed his experience. He does have experience on the banking side. So the company he worked for, he was uh, monumental, detrimental, whichever one you want to use, in bringing
Right.
the banking portion of the business. You know, the business originally was a broker,
Right.
and then moved to what they call a direct lender or a lender.
Right.
Um, and he was the one that kind of got that going in this company and pushed for it, and then was kind of like the main pusher along with a couple other people. I don't want to leave other people out, but they're not here, so who cares? Um,
Right.
but
They're probably going to be watching it
uh,
someday.
that's okay. They can call. They know me. They can call me and give me a hard time. And if they want, we'll do a special video and bring them on, and they can talk about all the great things they did because they did some.
Right. Those were good
But
days back in the mortgage boom,
yeah,
2004, 5, 6, 7, right around there.
eight not so much.
Yeah, I know. 8, it kind of imploded.
Yeah, but
So,
it is what it is.
yeah.
Like every industry, they have its ups and downs, and this industry
Right.
goes from just like every other.
Right. Right.
So yeah, so that's basically what we're trying to do here. We can touch on a couple of topics, if um, just some generic stuff, what's going on in the industry right now. If you want to talk about that, or you want to talk about, I don't know, where do you want to go with this? Do you want to go a little longer?
Yeah,
I don't know how long we've been going.
let's go a little longer here. Let me see where we're at.
Shoot
We're
for like an
about
hour. Where are we at?
no, we're about 20 minutes in because we had about
Okay.
a little over a 4 minute setup, 4 or 5 minute setup. So we're about 20 minutes in.
Yeah. Trying to think. So I'm kind of a Luddite. You know, thank God for Ricardo. He will work through this. I have no patience. I still think the internet is a fad and it's never going to catch on. Um,
Yeah, it's never going to catch
uh,
on. Now,
Never going to catch
every
on.
single major platform has an app and they're listening to every word we say.
In the 90s, I used to work in tech and I said that all the time and people laughed at me.
Yeah, exactly. Exactly. So,
Um,
yeah, I mean, uh, I guess, you know, I really want to just kind of make sure that we are connecting with, you know, it's basically that mindset of a current renter, somebody that's renting a spot. Maybe it's a room that they're renting with multiple housemates or apartment mates,
right.
and going along the lines, maybe they've been doing that for 3 years, 5 years, 10 years, 15 years or more. And they're, every year they're going, well, wait, I'm paying all this money in rent. Where's my equity? Well, you're giving your
So the thing
equity
to
away to the landlord,
the,
basically.
the thing to remember when you're thinking about buying a house, and we'll go into this in more discussion, but on another video in depth. But
Right.
if you're paying $2,000 a month in rent, and you can have a mortgage around the same amount, remember a portion of that mortgage is going back to principal. While sure, everybody will say, yeah, but in the first couple of years, the majority of it goes to interest. Yeah, but if you're giving your landlord $2,000 a month, he's not giving you anything back. If you give a lender on a mortgage $2,000 a month, let's say, and this is not accurate, I'd have to pull it up and look at it, but let's say you're getting 100, $300 back. Let's say it's only $100 back. I'd still rather have $100 back in equity as I pay the loan down
Right.
than nothing back from a landlord and have no ownership in the house that I have.
Right.
So, and then over time, that amount that goes to principal increases every month. And that's where you start to, and then also just over time, generally values go up. So now you're gaining equity. And
Right. There's
I don't really
multiple
want to
ways.
get into all of that right now, but if you've looked at the way the housing market has been, it's
Right.
going crazy. And for people that are, we don't know what's going to happen today or tomorrow. But I can tell you this much. If you're around in 2008, everything went crazy and everybody went in panic mode and people said, I'm never going to buy anything. I don't want to buy anything.
True.
It's way overpriced. That was in 2008. If you had bought a house in 2008 and you could handle the payment and you would have waited it out, those values came back and more.
Right.
So, sure, if you had an opportunity to buy in 2009, 2010, 2011, yeah, you should have taken advantage of it. And I wimped out. I had a property that was offered to me. It was a studio apartment in Santa Ana, California, a little condo. It was for $30,000. And at the time, I was like, oh, I was more worried about the association, the homeowners association, and were they going to stay solvent?
Right.
So I didn't. I could have wrote a check and bought it cash and rented that thing out for almost $1,000 a month at the time. And I was so worried about. I got so hung up on what was going to happen with the HOA if it was going to go bankrupt that I missed out on a great opportunity. And if I had bought that, I'd be looking at $2,000 a month right now, and a property that's probably worth 400, 500,000 right now.
Right.
So, we all make mistakes. And when you're in the heat of it and things are going crazy and everybody's crying, you got this Yahoo Jim Cramer yelling at everybody that the sky is falling.
Right.
It's hard to make those calls. We've all been there. We look at stuff and you go, well, maybe this one isn't the best. And it's understandable. But as long as you can handle the payment, if you're already paying $2,500 a month in rent and you can have mortgage payment around the same or lower or above a little bit and you can handle it and your lifestyle doesn't change, then it's worth it if you're going to stay in it. And let's say you're not even planning to live in it, but you can stay in it and move out and you've already checked the rents for the area. That's a very easy thing to do to find out what the local rental rates are. So that let's say you even think you're going to stay in it short term, maybe you're only going to be there for 2 years. Okay, well, what are the rents? Are the rents enough to cover or get you close to covering the mortgage and all the other costs associated with it? Then it's something to think about, because why not put somebody else in there that won't step up and have them pay your mortgage?
Yeah, the other people's money aspect of it is, uh, something
Plus
that.
the amount of write-offs. I mean, we're not financial advisors or CPAs, but there's some really good YouTube channels that maybe we'll discuss in a later video that talk about strategies
Sure.
and the amount of, financial advantages you get from owning investment property.
Exactly. Yeah, and that was, to touch on that a little deeper, even, the everyone that lived through and experienced, mentally experienced the 2008, 9, and 10 real estate downturn, and mortgage downturn. And all those people, like you had brought up, kind of threw in the towel. A lot of those people that threw in the towel was done so because the media, mainstream media, just totally painted this detrimental picture that, oh my God,
that
if
it
you
was
owned
never
a
going to
house,
come back.
just because your house value went down by 50,000 or even 100,000, that, oh my God, give it up. Well, when you really think about that, you give up a house, what do? Are you just going to go live in a tent underneath the freeway? No. You're going to go
I
rent
can use
something, right? And then when you
I
go
can
rent
use
something and you pay rent, do you have anything to show for it? To your point, no, you don't. And now you just agreed to
right.
go pay your landlord's equity. It makes no sense. It would make sense to go back to the drawing board, hire the right people to help you kind of negotiate that arena, and, you know, stay in the house. Because here we are, what? Let's hear, that was 10, 16 years ago. Is that right? No,
So,
somewhere
so
around there.
here's an example. Here's an example. My own house. I paid just under 200,000 for it back in 2000, 2001, somewhere around there.
Sure.
At the height of the market in 2008, they were selling for just under 600,000. The market crashed, and the houses in my neighborhood were selling for below 200,000. Like I think one sold for 150,000,
Sure.
and now they're going for between 7 and 900,000.
Exactly.
So if I would have walked away back then, I would have been making a huge mistake.
Right.
Um, and my house is nothing fancy. It's a middle income home. It's 12, 1,300 square feet in a nice community, very nice community. Um, and, uh, and you know, it's very well sought after just because of where it's at and what it offers without getting into details.
Sure.
Um, but I'm constantly getting offers for my house, constantly having people knock on the door and send letters to me, and we have a buyer, or we're in it. If you ever want to sell, let us know. We want to live here. So sure, the market's probably going to crash again, you know,
Right.
and it is what it is.
Right. We all have to live somewhere. You might as well get as much value
That's
for
right.
your investment instead of giving your landlord a great value.
And right now, rents are crazy right now.
Yeah,
You know,
that's
rents are
true.
really crazy. Um, they're kind of, from what I'm reading, you know, there's some leveling off and some lowering in certain areas, depending on where you're talking in the country.
Right.
But in the hot areas, you know, they're, you know, most people I'm hearing are, you know, 900 to 1,200 square feet. They're paying almost 2 grand,
Right.
you know, minimum, minimum. Um, excuse me.
It's all good. All good. So yeah, um, I guess you were mentioning, because you and I were both residing in California State. Um, you were throwing around some rent figures. $2,000, 2,500. You know, what if somebody's been renting and they're paying 2,000 or 2,500, and they go and say, "Oh, well, what can I buy for 2,000, 2,500?" And they see what they can buy, and that, let's say that price point is like not even a third or a quarter of what they need to pay in order to buy the house. Do you have any advice for those types of people that might not be considering to become a homeowner because they're like, well, there's no way I can afford to pay two or three or four times what my current rent is, if that's what the payment turns out to be.
Well, I would say now's the time to prepare then, if you don't think you're ready. And when I say prepare, that's where you might want to do one of our 15-minute consults, maybe even get pre-qualified, um, so that you can see where you're at. If you've got some credit issues you need to work on, best to find out about them now. We can walk you through how to correct those.
Right.
Also set some goals. So here's an example. We had a gentleman Ricardo was working with a while ago who was paying, I don't remember, but it was a substantially below market rent somewhere,
Right.
because he was, without getting into who and what, you know, rent should have been 2 grand, but he was only paying like 1,000. Let's just
Right.
use that as an
Right.
example. And he was, you know, asking, well, how much house can I qualify for? And I always say, well, it doesn't matter what I can qualify you for. You'll be surprised what you can qualify for The question is are you going to have a life? So that's when we generally ask the person, what do you think you can handle as a payment? That's the first thing we get to. And so like somebody I'm working with right now, they're currently paying about $2,000 a month in rent, but they're telling me that they can handle a $4,500 a month payment. So what I've told them to do is go set up a separate bank account with one that they do not have an ATM for, or put the ATM in the freezer in a glass of water and freeze it so you can't get to it.
Right.
And every month when the rent is due, write your check for $2,000 to the landlord, and then write another check for $2,500 and put it in that bank account.
Right.
And don't touch under any circumstance. And you will find out if you can handle that $4,500 payment you think you can handle. Because when you find out you can't go to this party, you can't go to that concert, you can't buy the kids shoes or whatever it is, you've set
No
the
more Disneyland.
the number too high. You've set the number too high.
Right.
But if you do it and you're able to do it, and you're just like, oh, I just don't go out to dinner as much, or I don't drink as much, or whatever. We don't spend money on useless things. We're not buying as many clothes as we used to buy that we ended up throwing away 2 days later.
Right.
That's how you figure out where you're at. So this does two things. One, you live within the budget that you think you're going to have, so you don't have what's called payment shock later on.
Sure.
Nothing worse than buying a house, and I qualify. So, that same person, I might qualify for $5,000. Well, you get into the house and you start writing that check for $5,000, you realize this is way outside of what we're used to.
Right.
So that's one thing you get to learn. And the second thing you get is you're putting the money every month towards covering your closing costs or move-in costs or your down payment. It's a nice forced savings. But you have to live like that money doesn't exist. Don't go pulling from other accounts to keep spending or running up your credit card. You've got to be able to run with that amount every month and not change the rest of your life. And in other words, don't then go, well, yeah, I had no problem. And then I pull your credit again. And instead of $2,000 on your credit cards, you have now $10,000 on your credit cards and your line is, well, because I had to put all this money away, I couldn't pay my credit card. Well, then that proves you can't handle that payment. Follow me?
Right.
So that's that's a good tester for somebody that is thinking about it. And then also gives you the chance to work through and clean up your credit and get your score as high as possible by getting pre-qualified or doing a consultation with us. Because we work the long game. We're not every loan isn't. A lot of my stuff never comes out like somebody calls me and goes, give me a loan, let's go. Right. Generally, it's a process, and it's sometimes it can take. I've had people that it's taken a year or two before we did stuff for them. And the nice thing is, if you've been investing all this time and preparing for it, you know what the process is going to be like when you get there, and it goes super smooth.
Exactly.
Because you've prepared for it. You didn't make those errors that a lot of people who just assume stuff make, and then it blows up in their face. Example is sometimes it can take, Uncle Bill gives you 25,000 in cash. Blows up. He's a cash kind of guy, and those days are over. Nothing can be cash anymore. Everything has to be transferred, and you have to be able to document it. So Uncle Bill gives you $25,000 cash right before closing. Nobody's going to accept that cash as your money unless you have $100,000 or $200,000 in the bank, and they can use that money as the money you have. And Uncle Bill's is just filling back in the emptiness that you drug all the money out of. You drained all the money out. You're just putting it back in there. You're not dependent on it to close the deal. It's just excess money that you're getting, and that's because of all of the terrorism laws and money laundering laws that are going on. So those are things. What else, Ricardo? What else you want to?
Yeah, I mean,
talk Trump? You want to talk Trump? Want to get this political?
Well, we're not.
I don't
No
mean
need.
talk about. I don't mean talk about Trump. I mean talk about the
The
fraud thing.
impact
The
of
fraud.
what they're doing towards
Correct.
the real estate market in one particular state, which is New York. It doesn't matter what
And
political
how that.
side you're on. That's going to
Right.
affect
Right.
everyone. There's
If
no like, hey, if you're Democrat, it doesn't affect you, or if you're Republican or
yeah.
independent or green
And
or
that's the big uproar
whatever,
that's going
it
on right
affects
now in New
all of
York.
us. All of us, what's
Yeah,
going
that's the
on.
big uproar that's going on in New York right now with a lot of real estate investors. And I think what really people don't understand is how that could go into the residential market, because
Totally.
the accusation is that he overstated the value. Well, in most people in the industry, everybody overstates or understates the value, because that's just the way it is at the beginning of a loan. You fill out the loan application and you put down what you think your property is worth. Well,
Right.
everybody's going to always generally put it at the highest they think that it's worth,
Right.
you know. And so if they know a house sold for $1 million in their neighborhood, they're going to say their house is, because that house was not as nice as theirs, they're going to say, well, mine's got to be at least 1.1, 1.2.
Right.
And so people always, you're just stating your opinion at that point. There's no proof of what the value is. And even in the situation with regards to his thing, what he's doing is he's putting up one property as collateral for another, which also happens in in the residential side, which is when you own multiple properties, you're using some of those properties not as necessarily collateral, but you're using them to show them as assets, and you're listing the values on those.
True.
And people a lot of, and you know, generally we don't really check the values on those because we're not collateralizing against them. So you might state that your investment property is worth 200,000 or 500,000 or whatever. We're not going to clarify. We're not going to verify that. But if it's later determined that you lied and it wasn't, or maybe you didn't lie, maybe you just, this is what I would sell it for if I sold it. Is that really fraud? I don't know. You know, I mean, there's a lot of things that go on a lot worse than overstating a value of a property.
Right.
In this business that are way shadier that really affect the loan. You know, and in his situation, he was using different properties as collateral to finance another one. And in that type of situation, it's no different than if you're doing a refinance in your house and you say, "Oh, my house is worth 800,000, and I want a $600,000 loan." The bank's going to go, "Okay, well, we'll get an independent appraisal to go out there because we don't think it's worth that, right?"
Right.
So we'll send out an independent appraiser. You'll pay for the appraisal, and we'll get an appraisal. Well, that's the same thing that happened in his situation.
Right.
They would have evaluated those properties and said, "Well, we don't think they're valued. We want an independent appraisal." Or they could have done their own, which their own. So since it's commercial, it's a little different. They don't always have to get an appraisal. They could have done a desktop review. Maybe they have their own appraisal department in their company, and they do a review of the appraisal and they go X, Y, and Z. And here's the funny thing: even if you get an appraisal and it comes back and it goes to the lender can look at it and go, "I don't care what that appraiser said, we still don't think it's worth that much."
True.
And they can either walk away or they can say, "This is the max we're willing to give you for value of that property, and we'll base the loan off of that."
Right.
And then you can make a decision. So what? Even an appraisal is not the end all be all.
Right.
A lender can whack it even more if they see a trend happening or whatever. Now, Freddie and Fannie, it's a little different, but I'm talking about just um, hard money or commercial property stuff. They're not required to maintain anything. So the other thing that's strange about that is that they put a value. I mean, I didn't go into all of it, but I did. You know, I hear a lot of stuff talking about Mar-a-Lago, not his other properties, because he didn't just put Mar-a-Lago up. I think he put some other ones, his other New York properties up.
Sure.
And the strange thing about Mar-a-Lago is if you're in California and in other states, in California, we have what's called Prop 13, and your property tax is based off of the price you purchased the house at. And then it can only increase 2% max per year. It doesn't necessarily be, it's not necessarily 2%, as high as 2% max.
Right.
There's a bunch of other factors they take into account. But so looking at his property, my understanding is that property was initially offered to the federal government to be the White House, the Southern White House at one time, kind of like how Camp David, it was offered as a secondary or another Camp David, but in the South. And the federal government didn't want it. And then they tried to offer to the state of Florida, and the state of Florida said, we don't want that thing. And then I guess it sat on the market for a while, and Trump picked it up at a depressed price. So, don't quote me on this. I think it was like $8 or $10 million or something. It was low, super low. And so if you calculate in Florida has a 2% rule, because I thought, oh, maybe they have the reason his assessed tax rate is so low is because they must have a cap like California does. So I looked it up, and they have like a 2% max that a property's taxable base can be increased by. So if you figure he's had it for 20, 30, 40 years, I don't know how long he's had it, but and it can only go up so much per year. Of course, that thing is only being tax assessed at 20 or 30 million, I don't know, whatever it is, instead of what the real retail value. It's like my house. My house, I think, has a tax as it's taxed at a value of just under 400,000 or something stupid like that, which is good because the state only wastes our money anyhow. But
right. I agree with you.
But if I sold it, I wouldn't sell it for that. I would sell it at market, which is between 7 and 900,000, somewhere in there.
Right. So there's two different values that we're getting at
Correct.
there. One is the assessed tax rate, which is limited in how much it can increase. But just because there's a limit on how much that can increase doesn't mean that the true market value couldn't go up 20% one year or 30% one year, and then maybe 2% the next year, and then 5% the next year. The true market value is going to go whatever it
and then there's also, you run into this. So, if somebody called me and said, hey, do you want to sell your house? I would say, yeah, sure. Give me, $975 or $175,000, and I'll walk out of it tomorrow. That doesn't mean that's the market. That's what I'm willing to sell it at. Right. So Trump could say his is worth X.
Right.
What really matters is when somebody will actually walk up and give you money for the house. That's what the true value is. Everything else is a guesstimation. What the appraiser puts down is just an educated guess based on local comps. What you list your house at is what you are hoping, or you're strategically either listing it low, or you're listing it high. And what a house sells for in your neighborhood is contingent upon so many things, in the sense of, what's the reason? Is there a divorce involved? Is there a death in the family? All these things can affect what a house finally sells for. Who's selling it? Is it in-laws who inherited it, and they don't care if they get $50,000 or $100,000 less for it because they didn't own it 2 weeks before, and they're just get rid of it and give me a couple $100,000 and I'm happy. And so homes sell below market all the time in neighborhoods, and that doesn't necessarily mean and that's where the appraiser, when you have your house appraised, you need to understand your neighborhood, so that when he comes and he says, oh, well, these are the comps and one sold low, you can say, well, you need to look at that because that comp isn't realistic because it was a depressed sale.
Right.
I'm sorry, I'm starting to go off on a little tangent there. But with regards to the whole fraud thing, if that's the only, and I'm sorry, I don't follow it. It just, it tires me out. But if the only fraud is that he stated his assets were at certain levels, the bank takes that into their evaluation, and then they will manipulate the numbers themselves and look at it. So when I was on wholesale, if Ricardo turned in a loan to us, we would look at it, and some things we'd laugh at. And there's no way that those two other properties he owns are worth that, because you can run an AVM and get a quick evaluation with a range, automated value machine, automated value. I can't remember what the M stands for off the top of my head. Drawn a blank. But basically, it just goes out and it gets public information, and it runs through it, and it tries to match up properties, and
right.
It's like using Zillow. Zillow is generally never accurate. It's either going to give you a high number or a low number, and the problem is it's not looking into all the details of the property.
Right.
They may be using properties that have higher square footage, and they're not adjusting for that, or they might be using properties that have lower square footage or that are depressed sales. Maybe it was a foreclosure sale. They're not taking that into account when that automated system is calculating value. That's really what it amounts to.
True.
So that's the only thing. And then here's another example of something that could be considered fraud. With it's not, but in the extent, like the example they're making of Trump with these values. If there's other things he did, that's a whole other issue. I'm only talking about the values.
Right.
But assets. But I've had clients who've come in, and they'll represent that they have $1.2 million in the bank. But then when you get the bank statements, 500,000 of it was recently transferred in. There's no history, so there's no seasoning on it.
Right.
So that might get backed out. So is that fraud? I don't think so. Technically, I guess you could argue, maybe,
right.
But I think you'd be hard pressed to prove that in a court of law. For criminal charges, civil, that's anything can get done in civil. But criminally, it's not fraud, and it never gets charged that way, because then you're talking about requiring the consumer to understand the guidelines, which even half the people in the business don't understand the guidelines.
Right.
Even you put 10 underwriters in a room, and you're going to get 10 different answers on how to handle something most times. And that's not a knock on underwriters. It's just people look at things, the guidelines different. So sometimes you have to massage it a little to get it to fit.
Right, and massaging it isn't doing any fraud. It's just having a meeting of the minds and saying, did you consider this perspective of the guidelines? And saying, hey, let's really do our due diligence and make sure that we're within that guideline box. And that's what I was talking about in the beginning. I love figuring out where's the macro stop at, right, of the guidelines, and then going, I don't know, you and I were talking about that maybe recently. There was a case where somebody went to a Bank of America, when I was managing the loan agents. We had like 30 loan officers we were managing, and back in the mortgage boom. But this one particular case, a client came to us and said he had applied at a Bank of America and got denied. And so I took on the application from that loan agent and was able to get it approved and funded at Bank of America. And the client, during the whole process, didn't believe he was going to get funded at Bank of America. And it's just understanding the guidelines, where the rep he went to at Bank of America didn't understand the guidelines very well, or maybe didn't ask the right questions, And so,
that's not necessarily true. I'll throw in this a little bit of a. So, hold on one second. Sorry, I got into something that I shouldn't have. Turned something on, and I was hearing myself talk to myself. So another thing you have to take into account is the major banks, the FDIC banks. They have very conservative guidelines for the loans that they fund in-house. And their guidelines are a lot tighter. So, and this happened back in the days of wholesale, like, because our company had both a retail division and a wholesale division.
Sure.
And the stuff that could be done in retail was a lot more conservative than what we could do in wholesale. And that's the way it also is with the big banks. You go to the big banks, very tight. They're like A paper generally, unless you're going, FHA or something. But they're pretty much, they're like a certain box they're looking for, and that's it. Unless you're a really good customer of theirs, they have a high turn down rate.
Right.
So that's another thing that it can be. And yes, generally, a loan officer at those places are not structuring loans. They're just taking an application and turning it in.
Gotcha.
They're not, I don't want to say any names, but there's also a bunch of direct lenders out there that advertise a heck of a lot. And a lot of those places that are high volume, they're advertising all the time on the radio and stuff. They have their niche, and the calls come in. There's a script, and the script is to get the client to fill out the application and get their docs in. They don't even do the analysis of the loan. Whereas on our side of the world, in the broker community, we do a little bit more of for lack of a better word, an underwrite. It's really not, because we're not underwriters, but we kind of know what the guidelines are, and we're in deep into the guidelines, and we can figure out where that loan can go based on the client's needs. And sometimes the loan the client can qualify for isn't a loan the client wants.
Right.
There's generally a loan out there for everybody. It just doesn't fit them at that moment, And if somebody's coming in thinking that they're going to get 2%, that might not be the case.
Very true. In this market, rates are a little different. But talking about rates being up, a lot of times people might, if we're talking about a renter that wants to become a homeowner, and let's say financially they can afford the payment and the price point and everything, right? Let's just say that all lines up, but they're not comfortable proceeding because, in their mind they think 7 or 8 or whatever percent, 9%, wherever it comes out, maybe it's 6%, maybe they think that's too much, right?
Well,
that's too much interest to pay. Well, really, is it too much
interest to pay? There's a bunch of people right now that are sitting with 7, 8, high 6s, 7s, and 8% rates that a year or two ago wouldn't move forward when they were at 5.
Right. Exactly.
So sometimes, the buy low, sell high, all that stuff doesn't make sense. If you can qualify, here's the thing you got to look at. If you have found the house you like, but rates are high, and this is let's say you're looking for a dream house, right? You're not just first-time home buyer trying to get into anything. You're, oh my God, this house, I've been waiting for this house to come on the market, and it's on the market. And I can afford it, but I don't like the interest rate. Well, here's a problem. If you wait for rates to go down, or hope the rates are going to go down, and you're going to gamble, that house may not be available again. If somebody else who wanted it bought it, and maybe they have no intention to ever selling it, and it's their dream home, and they're going to live in it for the next 30 years.
Right.
So the way I look at it is, if you can handle the payment, you don't worry about the rate so much. You worry about yes, you always worry about the rate. But what I'm saying is, if you can financially handle it, and it's the property you want, you buy it. because one of two things are going to happen. Rates are either going to go up and they're going to go down. If rates go up, you're going to think you're smart and you got it at the right time. Because if you didn't and you wait and they go up, you're going to be kicking yourself, right? And you're still going to take that higher rate sooner or later because you're just going to say, I got to do it sooner or later.
Right.
And if rates go down after so much time into the property, you can refinance. It makes sense to refinance. So let's say you buy it now and it's 7%. And 2, 3 years, 4 years, 5 years, whatever, next month, who knows? Rates drop down. And it makes sense. That's the other thing that has to make sense.
Right.
You look at refinancing. Or maybe instead of just a straight refinance, maybe even shorten your term. You take yourself from a 30-year, maybe you keep the same payment, but your interest rate goes down, but you also cut off 15 years. You go to a 15 or a 20-year term.
Right.
So you keep the payment the same because you've been living with that payment for the last 4 or 5 years. But you also shorten the term, which is going to save you a ton on interest.
Right.
And you lower the rate a little bit.
It's true. And a lot of times when rates are higher or they're on the upswing, does that mean that usually that the house values are also raising exponentially? Usually values are kind of opposite of what the rates are, right?
I wouldn't use history on that because there's a housing issue to a certain point in the sense that, you know, I feel like they're deliberately not building homes. And I don't mean the builders, I mean government is slowing that down.
Agreed. That's a whole nother discussion, which will be a whole different topic.
We can go down that black hole.
I'll just give you the acronyms for it here in California. CEQA, California Environmental Quality Act, but that's a whole different topic. There's a big rabbit hole on that one.
They also want us to build up and smaller, and instead of out. You know, there's plenty of other places to build cities, but they tend to want to force everybody into the same city. But I'll get off that soapbox.
Right. So my point is, like you just mentioned, you know, if it's affordable, if it's the dream house like you talked about, pull the trigger. Be a homeowner.
Right.
You know what I mean? Start getting the equity of these homes. Don't treat the house like a stock or like crypto.
Right.
A house is like get rich. If you're going to be buying units and whatnot, it's a get rich for sure, not get rich quick. It's get rich for sure over the long haul. That's what it is. You're not moving in houses and out of houses every month, every year, every 2 years.
No.
You know, and trading it like a stock. It's not that way. You know. So.
Well, I think long term, the best thing is to buy and hold. If you can figure out a way to buy and hold and buy more,
right?
You know, that's the way to go. Because you buy your first property, you get into it in your 20s or your teens. True. You live in it for a couple of years, you know, through college maybe, or through your first, you know, couple jobs, and then what do you got to lose? You know, really.
Right.
Over time, it's gonna, you know, things long term always pay off. One of two ways: you either pay the loan off completely and you own it free and clear, or the equity you build from the house increasing in value. True. And sure, they have costs, and you're responsible for it all. But if you think that you're renting a place and you're not paying for all that stuff, you're crazy. The landlord's passing all those costs on to you.
Right. Might not be immediately, but on that renewal of the lease, your rent's going to be increased to pay for everything.
Well, if they're doing it right, they're doing a reserve study on their property, and they're calculating all the different costs that property is going to have based on life expectancy of each thing.
Right.
And they're breaking that down into a monthly number. Right. And that monthly number is added into their rent. So, you say, oh, well, in 20 years, I'm going to need a roof, and 8 years, I'm going to have to paint the exterior,
Sure.
this, that, and another thing. All those things are calculated in, and you come up with a monthly reserve contribution. Even though they haven't happened yet, you're charging the renter for it now, so that when you get to that point, you have that money there. Um, it's if you belong to an HOA, it's the same thing that the HOAs do with all their costs. A lot of their costs that are long term, they will do a reserve study, and then they will break down those costs and figure out how much they need to uh, collect in dues, so that they have that money down the road, so they don't have to do a one-time thing.
Right.
Another thing, since we're on HOAs all of a sudden, if you're looking to buy a house and an HOA, is one of those options, make sure you read all the documents. Make sure you get copies of all the governing documents, their budgeting, copies of the reserve studies, and you just disappeared. And read through them. Read through them. So here's the thing with buying a house. You choose on emotion, but you buy it without emotion. And you have to be willing to walk away from it. Don't get caught up in it that you're in love with it. Love it when you pick it, and then after that, you have to treat it like an investment, and you have to nitpick it and forget about how much you like the neighborhood and all that, the stuff that doesn't matter. Now you have to go through and you have to really tear it apart and tear it down and nitpick through everything to see if it's going to hold up to that initial feeling you had when you walked in and were in love with it. And that's the same way it should be when you're looking at a property that's in a homeowners association. Your camera keeps turning on and off, by the way. Um, uh, you want to look through that thing and make sure it's financially sound. A lot of HOAs are not. You want to make sure that they have all the proper coverage. You want to try to figure out how they're managed. Are they a Nazi organization, or are they, a little laissez-faire, which can be just as bad. So if you got an HOA that doesn't get involved and lets a lot of things go, it can really ruin the neighborhood. But then you can have some that are like, you see these videos where the guy is, walking up and knocking on the door and screaming about, you had too many packages delivered today, and they've been sitting on your front porch too long. And the rule is you can only have a package sit on your front porch for 2 hours, even though you're at work. So those are the things you need to look at when you really need to analyze it and ask around and talk to people, talk to the neighbors. What do they think about the HOA and stuff?
Right.
And then you have to calculate that into your total monthly payment. So your total monthly payment is principal, interest, taxes, insurance, and then HOA if you have it. And then there could be some additional things that are on that too. Melrose, if you have Melrose, which is an additional property tax. It could be flood insurance, or is the property in a flood zone, or in some other major disaster area where you pretty much have to have coverage. Yeah. Well, you're not required to have earthquake insurance, but you're required to have flood.
Correct.
But also, and while the lender may not take earthquake insurance into account into your total monthly payment, you should.
True.
So we won't take earthquake insurance. So if you plan to put earthquake, that's an optional insurance. We're not going to calculate that into your debt to income ratio. But you should, because it's something that affects your ability to spend.
Right.
Or to live. So, but you do want to know if you're in a high risk area for fire or flood, those types of things, because sometimes those have extra costs, and you may choose not to want to be in that area then. Or I was looking at a property out of state, a beautiful property, beautiful house. I'm like, oh my gosh, this thing's great. What's wrong with this? Why is it so low? And then I just clicked on the terrain map and I noticed, I hit the flood button. And sure enough, the house was in a flood zone that they were saying that it was definitely going to flood in the next 10 years.
Well, yeah, you're right. I
So
mean,
we took a pass on that, you know.
no, but that's a good thing to mention because when people do start looking at their houses, it's important to also get the right search parameters noted in there because you could accidentally click something in this day and age that you didn't realize you clicked on, and you maybe see a great price, and that great price is because it's guaranteed to flood in the next 5 years or something. So,
Or there's a railroad track right behind the house,
right,
or on the other side of the hill that you never drove around the neighborhood. And
right,
around the neighborhood, I mean like within a circular mile of the neighborhood, not just the block that it's on
right,
in the housing tract. I mean, you drove around, you drove around, and on the other side of the hill, there was a hazardous waste, or a, what is it? What's it where they drop off the trash, um,
landfill,
uh, landfill. Thank
right,
you. A temporary or a local transfer station. So all the dump
true,
trucks go there and dump it off during the day,
right.
and
You've
then
got all of a
put it
sudden
on the
50
other.
dump truck or 50 trash trucks driving by your house at 8 in the morning.
Yeah,
Boom,
or
boom,
they're on
boom,
the
boom,
roads in
boom.
there.
What is
But
that?
they're on the other side of a hill and they're dumping all this stuff, and it's being sorted to go off to different landfills.
True, true.
So you want to know that kind of stuff. Or is there a school nearby that you don't want to be next to, or
Right,
certain types of businesses,
right,
that might hurt the value? Or the other thing you'd want to do is also check with the city planners and see what they're planning for the area, because
right.
maybe they're planning to put a stadium there or
True,
something there, and you decide, I do not want to live next to this because it's going
right.
to increase the amount of traffic or whatever.
Yeah, I mean, you're
So
bringing
those,
up a lot of great things, and as you're bringing these up, I have a bunch of other things that over the years we've encountered on different transactions and whatnot. We could even make a special episode about all the types of areas to consider in the list of what you want to look into before you decide on pulling the trigger on the house, on buying the house.
right,
So yeah,
right.
so
And you really have to get out of that starry-eyed, I'm in love with the property.
right, right.
Um, I was at a auction a while back, years ago, probably 20 years ago. And I was there to bid on this one property, and it bid it up past where I felt it should go because it needed a lot of work, and I wasn't. Well, like the floors need to go down to the subfloor and be rebuilt up and all that kind of stuff. And and there was another lady there that was bidding on another house, and she had a professional with her that was there to assist her.
Mm-hmm.
So she was paying this guy to help her go through the process. And she lost composure during the auction. Like, you always hear about people getting caught up in the bidding.
Mm.
Well, she got caught up in it, and her guy told her, hey, you've hit the number you said the max you wanted to. Let's stop. She's like, no, I want it. I don't care what the price is. Well, the problem with her saying that out loud, and he tried to tell her, stop talking. She kept saying, no, I want the house. And she got very excited and upset. Well, in the back of the room were 10 investors sitting back there that were laughing and thought it was funny. And they bid the house up knowing that she was going to keep, they didn't have any intention to buy the property.
Right.
They were just, they thought it was amusing. I mean, I think it's kind of unethical. Why not let her take the house?
Right.
There's plenty of other houses. You're not even interested in it, and you're bidding on it just to mess with her because she's out of control.
Right.
But you have to get to where that's the problem with a lot of people. They fall in love with it, and then it's no longer logical, and you have to get into that Spock mind and be very logical. Once you make your choice, then you have to stop with the love affair, and you have to the emotional side of it. You have to go into the unemotional side. How are we doing on time?
It's so true. It's much like a kind of like a poker match. You don't want to give your hand. You're not sitting there with all your hands for everyone to see and hey, I got this budget. Yeah, you don't want to do
Yeah.
that. So yeah, we're about an hour 10 right now. So I think we had a good introduction
Yeah.
this round, and you know it's only going to get better. We're going to give a lot of good information on the channel. I look forward to sharing. I think we're trying to schedule it to where it's going to be twice a week. Is that right, Rob?
Yeah, and we'll try to get the time to be consistent
Yeah, we're gonna.
too, so that
As
like I think we're a little early on this. We're gonna probably try to do a little later. I don't know. We'll see.
we'll try a couple
We'll see.
different timelines throughout the day to
Time.
see where we can get into some of the market. And obviously, this is our first one, so once people kind of get an idea of what we're talking about, we'll find our audience, and we look forward to sharing
Yeah.
our knowledge and breaking the home ownership process down.
And as the kids say, like, share, subscribe,
Yeah,
comment.
please, if you liked it, hated it,
Even if you hated us or you want to tell us
do
we're,
whatever you want to do. You know,
if you want to talk
thumbs
about
up, thumbs
Ricardo's
down.
hair,
Right.
yeah.
The little hair I have. At least I have
I
hair,
mean,
not like this guy.
I got some right here,
Oh yeah, you do. You do.
making up for it.
Right on.
Well, I have it. It all slid down my back.
Oh,
So,
okay. Okay, cool. Yeah.
but yeah. So if you have any suggestions or you just want to berate us, feel free.
Yeah,
As long
definitely
as
throw any
you're up
comments.
to YouTube. YouTube's the one that's going to take care of you, not us. So if you say something that you can't on YouTube, I just not say anything you can't say on YouTube, so you don't get locked down. But I don't care. Say what you want.
Yeah.
Mock us.
Yeah, for sure. Definitely leave any comments down
Because
below
any
for future
comment, even if
content.
you don't like it, even if you down thumb it, it's still, from what I understand, it helps the algorithm. So we don't care.
That's true. I really don't care, and I've
Yeah.
been around so many clients. I try to help as many and please as many clients as I can, but there's no way I can get along with everybody. So, I'm just going to be, first to say that. And, I'm not looking to get along with 100% of everyone. So, but I am looking to connect with the people that can appreciate, heartfelt and genuine, customer handling, and making sure that we can, give you the great service level to help you become a homeowner. Tongue tied there. So, but yeah. So thanks for tuning in, and we look forward to future broadcasts for all of you.
Thank you.